sure that everyone is aware here, the what we have going on. For today, our speaker is Mr. Kyle Swafford. He is an attorney with Robinson Franzman LLP, and he is going to go through some great content today. But before I hand it off to Kyle, Kyle is a member of the firm's corporate and commercial real estate practice groups and represents clients in a wide range of corporate and real estate matters such as real estate syndication, tax implications for real estate funds and investors, joint ventures, and commercial lending. Kyle has several years of experience with both the Georgia Department of Revenue and the Internal Revenue Service in a range of taxation matters. Kyle lives with his wife in West Midtown with their beautiful blue Merle Australian Shepherd named Sadie. So Kyle, I'll hand it over to you to walk everyone through tonight's presentation, and thank you very much.
Absolutely, Chris. Thank you. And really, before I kind of get going into the presentation, I just want to say a few things. One, thank you, Chris, for having me. It's not lost on me that, there are probably some other attorneys that you could have had on tonight, and I appreciate you thinking of me. And hopefully, this will be some sort of kind of information for a lot of you guys and girls that might be on that are kind of either passive or active investors, and kind of what's the role with both of you. And I also want to commend everybody that's listening on this episode or this meeting tonight. A lot of this stuff can be scary at times, or particularly investing in your first deal, or kind of even figuring out where to start. And it's certainly not lost on me the how brave it is that some of you might be putting yourselves out there in a space that you might not have been in before, or even if you were in some sort of financial lending before, financial advisory, to kind of take hold of that and to open yourself up into multifamily self-storage, cap rates and insurance and prep returns and cash on cash and all this lingo that you're kind of learning on your own. Stick with it if it's something that you want to be a part of. I've alone seen clients that started in accounting, or a school teacher, or a retired highway patrolman. And I kind of just want to say that this is a space for everyone of every background. And all it takes is, your drive and your dedication, and you can go as far as you want to go. So commend all of you for being here and kind of putting yourself in a space that maybe you didn't think that you'd ever be a part of. You might have seen an apartment complex and thought, that's a nice place to live, but maybe now you're changing your focus into that's a great asset to buy, right? Or whatever that may be. So all of you should really be proud of yourselves for kind of taking that initial step, whatever that may be, or repeat of some kind. And again, Chris, thank you for having me. One of the things that we'll kind of talk about is syndicating, and understand too that this presentation is for y'all. It is not for me. And Chris, if I'm kind of, if this group already knows what a 506B is as opposed to a 506C, let me know and we can kind of move forward. I know that you allotted me about 45 to 50 minutes to speak, but I actually might dial that back down a little bit, maybe somewhere in the 30 to 35-minute range, because I found in my experience that a lot of information in the presentation, while helpful, there's a lot of questions that come after that. And again, this is for y'all, not for me. And I want to make sure that I've addressed any questions that people may have. Feel free to maybe put a question in the chat at some point, but there'll definitely be at least 15, 20 minutes where there's going to be conversation, where you can directly ask me some questions, and hopefully that I'll answer some of those questions by the end of the presentation. So why don't we go ahead and get started? And I might kind of skip through the slideshow presentation that I have. Can y'all see my screen, Chris?
Yes, we
tried to
got you.
share it.
We can see it perfect. If you want to put it in presentation mode, you can do that also.
No, whatever. I think this is fine. That way I can kind of see the tabs on the other side. This is a good picture of me. I have not yet shown the gray in my beard just yet. I'm sure some of you guys out there kind of know where that's going. So I'm sure there'll be enough gray hair. My wife is expecting our first child in about 4 weeks. So I'm sure the lack of sleep will be a part of that for sure. So I kind of want to skip to this slide right here. So kind of what we're talking about is the role that both passive and active investors have in a syndication. The way I kind of looked at it, and this is something I saw on LinkedIn that I think is a great illustration. A syndication is much like a plane. Your pilot is the sponsor or the Class B member or the manager, however you want to consider that. But a plane isn't anything without its passengers, and the passengers are the Class A or the limited investors, the passive investors that aren't taking an active role. And you can't really have one without the other. The passengers need the pilot needs the passengers, and that's kind of what makes the team whole. So a syndication can look something simple like what you're seeing here on this slide, or it can look something like this. This was probably the first largest syndication where I was a part of. You had a group over here raising capital, group over here raising capital, putting the money here, 3 different properties down below, and it can be as sophisticated as you want it to be. And I'm fine with emailing this to you, Chris, afterwards, and you can send this to whomever. So anybody that wants this will be able to have access to that. But kind of what I understand this to be is kind of what's the role that the Class B and the Class A have together? What are questions that Class A, and by Class A, I mean passive investors, what are questions that passive investors should have for sponsors? What are things that sponsors should be aware of? Chris, is that an accurate summation of kind of what we're talking about tonight?
That's right. That's right. I think it's a great place to put it there, and going through, as you mentioned before, 506B, 506(3) actually, excuse me, 506B and C actually would be good for this group to have them understand how that works.
Okay, fine. Perfect. So basically what you're going to see when you're doing a syndication is you're going to have some sort of distinction. You're going to have Class A, which are the passive investors. Perhaps the Class B says, hey, I've got this great opportunity, but I need some help with the capital. That's where the Class A group comes in. So the Class A investors will have a certain percentage of the ownership. Typically, you see that anywhere from like an 80-20 to a 70-30, 70 or 80 being in favor of the Class A passive investors. What the passive investors get is they get typically a preferred return, which is, for example, if you give $100,000 and it's a 7% preferred return, you're guaranteed $7,000 each year. After that, there'll be some sort of profit split. So there'll be a 70-30 split. So that means for every dollar after the preface paid gets split 70-30. 70% goes to all of the Class A, 30% goes to the Class B members for managing it and finding the deal. That's the loose structure of it as we kind of get into how these two play an important role. The passive investors help fund the acquisition, and the Class B members manage the acquisition. So they decide when we're going to refinance, when we're going to sell, when we're going to raise rents, when we're going to renovate certain units, and you're leaning on their experience in that space and the research that they've done ultimately for you to kind of get some passive income or mailbox money, as the kids say. And typically that comes in this sort of scenario, 6 to 10% preferred return. Typically that's paid quarterly. So in the previous example, let's say it's an 8% pref, so you're guaranteed, $8,000 in that year. It'll probably be $2,000 in quarter one, $2,000 in quarter two, etc. Now, keep in mind, if you're a passive investor, there may be certain situations and times where a preferred return is not paid. For example, let's say that you're in quarter two and it's the month of May, right? Your GP team may say, hey, we have cash that we could distribute. However, we think now would be a really good time to renovate some units. We know at the end of May, in this 100 unit apartment complex, there's going to be 10 units that are vacant. At that point, we want to deploy the cash that we have reserved to getting new stainless steel appliances. Maybe we want to update the cabinets, change the flooring, update the bathrooms. And in doing so, every month thereafter, we might have only been getting $1,000 a month, but now we're going to get $1,500 a month. That's otherwise going to increase the cash flow down the line. So that may be a situation where a preferred return is not paid in that quarter, but it's going to something to help bolster the asset. If you're a Class A member, don't worry. Before the Class B member will ever be able to pay themselves, they will have to not only pay the current preferred return, but any previously unpaid preferred returns. So you're always going to be guaranteed a preferred return to the extent that it was missed. And if it was missed, it was likely because they were implementing their business strategy, and that should not be a cause of concern. So in your typical syndication, this is what you're going to see. You're going to see your 70% from your passive Class A investors over here and your management team over here. Your management team might be comprised of a few different people. Perhaps someone specializes in underwriting, area familiarity, and market trends in Houston, Texas, for example, or you know what, Atlanta, where I'm located. They may have boots on the ground. They may know the Atlanta market very well. Another person may be someone that can help implement the business strategy. Maybe they have construction experience and they understand the renovation plan and how to fulfill that. Maybe they've been a property manager in the past and they know what to look for in terms of adequate tenancy or adequate tenants and retaining that tenancy. So that's one of the things that you want to keep in mind, like who is your GP team? And you want to find out more about them. If you're a Class A investor, one question you may have is, what have you done in your career thus far that would lead to success in this particular industry? That's a question that you might want to ask. You might want to ask, what research have you done in this market to justify your business plan? i.e., if you think that rents can be increased by $250 per month per door, what is your justification for that? Maybe that's the apartment complex across the street. Maybe there's a population growth that is certainly happening in Texas as a whole, and certainly in Atlanta and various other states like Florida, Idaho. North Carolina is a hot emerging market for any of those Class B members that are looking for an area to tap into, South Carolina and Virginia. So they're kind of seeing there's some growth here. Amazon said that they're going to open up a warehouse in this location. That's going to employ an additional 40,000 people. Rents are going to go up, and we're getting in there ahead of time, right? So you kind of want to ask, why are you picking this location? What's your experience? How do you foresee implementing your business plan? What are the preferred returns? Things along those lines. And as sponsors, you should know those answers because that would have been the entire reason that you submitted an offer to purchase the property to begin with, right? So you should be mindful of those questions. Why should someone pick Chris? Why should someone pick Carlos? Why should someone pick Kyle? Well, the reason you should do so is ABC. Here's the reason this business plan will work, and here's current market trends, et cetera, et cetera. I think I've kind of covered some of the questions that you want to ask and some of the questions that you want to be mindful of. So when you're looking at an offering, if you're a sponsor, you typically are going to fall into one of two categories, a 506B or a 506C. I think of B as in both. A 506B allows for non-accredited and accredited, so it allows for both. Whereas a 506C, Chris, I'm just going to allow people in because I'm kind of used to that along the way. So a 506C is for accredited only, C accredited, B for both. So to be a 506B, you cap yourself at 35 non-accredited but sophisticated investors. Well, what does that mean? Well, an accredited investor typically is going to be someone that is a single individual that has made $200,000 a year with a reasonable expectation that they will in year 3. Perhaps they're married and it's $300,000, or they have a net worth of $1 million excluding their primary residence. Now there's obviously other categories, like you might be a trust with certain amount of funds. You might be a business that has certain amount of profits. That's getting a little granular, but your typical accreditation status is going to be from an individual standpoint. If you do not meet one of those three, meaning single to 200, married 300, or individual or couple with $1 million net worth, excluding your primary residence, then you're going to be a non-accredited investor. I would be a non-accredited investor, so there's no shame in that. So when you're looking at the 506B, typically this is where you're going to kind of find a friends and family type of situation. To be a 506B offering, you must have had a pre-existing relationship with someone. Obviously, as anything might be with the federal government, they don't typically define things for you. So you kind of have this guidance as to what that means. If you have to think for a second, what do you think a pre-existing relationship would be? It's probably someone you went to college with, probably someone you work with, probably a family member, a close friend, a work colleague, someone that you know, right? That would be a pre-existing relationship. A pre-existing relationship would probably not be your cousin's work buddy that is interested in getting into multifamily, right? Like you don't know that person. Now you can get to know that person and you should continue to network. One of the things that I actively recommend with clients is a 3-touch rule. So if you're wanting to continue your network and you want to make sure that you're satisfying this sort of pre-existing relationship requirement, I suggest doing an initial meeting where you say, hey, Bill, thank you for taking the time to speak with me. I want to know more about you. You know, what college did you go to? What's your profession? What are your investment goals? What investment properties do you have now? 401k? Do you have a condo that you rent out? Do you have a house on the side that you rent out? Like, you want to know things about this prospective individual that you otherwise would already know of friends and family, fraternity friends, college buddies, things like that. So you have that first meeting. About a week later, you have a follow-up meeting or email. Hey, just wanted to reach out again. I know last time we spoke that we talked about this, and this, and what I do, which is invest in multifamily or self-storage or warehousing, or I believe you said ATMs earlier, Chris. Like you are syndicating, you have a particular business in mind, and then that's where you have pitched it. So your first meeting is getting to know the individual. Your second touch, if you will, is following up. And then your third might be, hey, I have this deal under contract in Atlanta, Georgia. In the past, we've discussed about you possibly investing passively and what that might look like. Would you like to hear more about this deal? And then you form that pre-existing relationship. I would highly advise against having a deal under contract and then trying to force your way into the relationship. Again, as far as the SEC is concerned, it must be pre-existing prior to the offering. Now, that doesn't mean, for example, that if you get something under contract, typically you have like a 30-day due diligence and walkthrough and whatnot, that you can't be actively pursuing people at that time. But the moment that you have that you're past the due diligence and you're looking to raise capital, you need to make sure that you form that pre-existing relationship with those individuals at that time. And obviously, as the slide indicates, with a 506B, you're not allowed to generally solicit the offering or advertise it in any meaningful way. Facebook, LinkedIn, running an ad in the local paper. Who reads the paper anymore? But that would be another way that you might consider trying to advertise this deal. So here's kind of one of the questions I usually get is, well, how do I know if I'm soliciting this matter? What I tell people is, you are allowed to discuss things that are going on in your life. So let's say that you're at a wedding reception and someone says, hey, Chris, your mom tells me that, you've started this new business, whatever. Yeah, I'm looking to get into the multifamily space. Oh, okay. What does that mean? Well, I'm actively looking at apartment complexes in various areas. Oh, okay. Can you tell me more about that? Sure. Things are going well. I've actually got a deal under contract that I'm really excited about. Would love to talk to you about this some other time. Well, you haven't said anything of really of any import there, right? Like they don't even know how many units it is. They don't even know where it's located or anything like that. Now, if you said something, yeah, I'm actively raising capital. I have this 120 unit deal in Houston, Texas, and it's going to be a 7% preferred return. Da, 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 da. Well, now you're kind of like goading the person into coming into you, right? Like that would be soliciting, and you're doing so to someone that you don't have a pre-existing relationship with. Again, if you're doing a 506B, that's not allowed. However, if you're doing a 506C, you can do whatever you want. You can get a smoke plane to write it in the clouds and blazon it across the heavens if you want to. I think that would be a little odd way of going about it, but I want to be there and I want to see that video of that plane taking off. But typically the point is you can network this to anyone. You don't even have to know them. You can just say, oh, you're a doctor and you're looking to invest passively. I got something for you, right? Now, when you're doing a 506B, you're allowed to take that investor at their word because you have that pre-existing relationship. If I have a buddy from college that I know has his own business and I've been on trips with him and I've seen the things that he's done and he tells me that he's accredited, well, then I believe him. Why wouldn't I believe him? I have that pre-existing relationship. In a 506C, they have to verify that. Now, there's a lot of companies out there. I don't have a dog in that fight. You could easily Google accreditation syndication company and thousands will pull up. So you can pick any one of those. The accredited investor could use that. They could get a written letter from their CPA or their attorney saying as such, and you're allowed to rely on that. So I think that kind of discusses the difference between the 506B and the 506C. Again, 506B is for both kind of friends and family. You're capped at 35 non-accredited investors. You're not allowed to solicit it, and it should only be with people you have a pre-existing relationship with. At 506C, you can go for it. You can put it on LinkedIn, Facebook, run ads, whatever you want. So that's kind of where that's going to come into play.
Hey Kyle, quick question for you.
Sure.
Before you move off of that, there was a great question by Teddy in the chat, and he says for 506B, he can see the 35 investor max, but can you have two investors that know each other well get an LLC together so that they can count as one investor in a deal?
So that's a great question, and the answer to that, unfortunately, is no. I'm not one of those attorneys that tries to manufacture a yes, and then you get an SEC complaint and come back at me, right? I can't afford that E&O insurance. So I'm going to be completely transparent and honest with you this entire step of the way. The SEC does what they call a look through. So for example, let's say that you got a buddy to say, hey, I can raise all this capital. And he comes in as an LLC and there's 30 people that are non-accredited and 20 people that are accredited, right? The SEC is going to look through that and say, okay, that's 30 non-accredited people. You got 5 left. So be mindful of that. So you're not allowed to try to manufacture your way into one. The SEC is going to look into that and treat that entity as it doesn't exist and then take it to the next level of counting the people. In terms of if it got audited for some reason or if they had a reason to look into the syndication itself. So that's a good question, but no, they're gonna do the look through rule. I think that answers that question from Teddy. So are there any other kind of questions that you kind of want me to hit on, Chris, real quick, or?
Nope, you can continue on. No other
Okay,
questions.
Another question that sometimes that we get is this crowdfunding concept. Maybe you try to raise $1,000 from a bunch of different people. If you've kind of been in the space before, I think Grant Cardone is known for this and whatnot. And we don't do that. We don't create these sort of crowdfunding entities or structures, largely because we have several clients that have they're either doing their first deal or they're doing their first deal this quarter and they already have 3,000 units under their management. The reason why a lot of people go against the crowdfunding is the exhausting administrative functions that come with that. You're constantly re-regulating it and reformatting it with the SEC to update for every single individual. That's so many more bank accounts you got to be mindful of, ACH payments or wire transfers. If you're doing wire transfers to do the distributions, you're accruing more fees. So you're better off syndicating than going the crowdfunding route. Typically, too, if you're going crowdfunding, that might be that one person's only $5,000 that they have, and then bam, their car breaks down. Well, they're not going to be able to get their liquidity back because that money's already been deployed to purchasing the asset, and you can't just like sell 0.2% of an apartment complex, right? So another reason that you don't want to get into this sort of crowdfunding space is it limits yourself to try to cash somebody out of a deal over $2,000 anyways. It's just a bookkeeping administrative nightmare that we actively turn people away from, that I think as a whole a lot of people have realized, oh yeah, that would certainly be a nightmare, and something that I don't want to be a part of. Um, just a real quick to kind of illustrate a sort of timeline for both the Class B sponsor and the Class A passive investor. This is typically what a timeline might look like. In late March, you might have finally gotten the PSA executed. You have maybe 30 to 45 days of due diligence. Now, what that due diligence means, Richard, that's a great question. I'll get to the fund of funds in a second. What the due diligence looks like is they're reviewing all of the financial records. They're reviewing the rent roll, they're touring the property, making sure the plumbing is adequate, the roofing is good, the infrastructure is sound, that if the seller says it's a 100-unit complex and we got 90 tenants, you're actually counting that there are 90 tenants, right? You're making sure that the property isn't in such a disrepair that you have to repair all of this anyways. So they're doing a lot of front work into getting that resolved. Then they're probably spending an extra 10 days getting their syndication documents, and then bam, they release them to Class A investors like yourself. You sign the subscription agreement, you get all of the capital wired, and then a week later you close. I hope that this kind of illustrates what that might look like. If you're purchasing a $10 million property, for example, just for easy math, you might need to raise $2 million just to cover the equity difference that the lender is going to require, right? Lenders are only going to lend up to 70 to 80% of the value of the property. So they need to get at least 2 to 3 million to have the down deposit. Then they might want an extra million for renovations or operating reserves, cash reserves, maybe 6 months of debt payments just to make sure that things are flowing appropriately. But then the cash flow starts generating, the business plan gets implemented, and then that's when the distributions start to come. So if you're a Class A investor and you haven't received a preferred return in Q1, Q2, or Q3, that makes sense. That maybe they're buying a apartment complex that's only 70% occupied, and they're implementing a business plan and a renovation to bring people into that location. Once the cash flow picks up and they go to refinance the property, maybe in year 2 or year 3, that cash flow is when you're going to get a bump up on all your preferred returns and probably a return of your initial capital. And then you just own whatever percentage, and when you go to sell, you find the same thing. So I hope that kind of explains a little bit about the timeline, the role that Class A and Class B members have together, the differences in the 506B and the 506C. Now, PSA is a purchase and sale agreement. Now, someone asked, what about a fund-to-fund type LLC with the 506C offering? Yeah, so if you're doing a fund-to-fund, this is typically for those that, let me go back to a previous slide and kind of try to explain this. A fund to fund would be something like this scenario over here, where you have a fund of fund that comes in as a Class A investor, but it's holding a bunch of the Class A units, right? This person or this fund will be looked through to all these investors up here, up here, up here, up here. So if you're doing a 506c fund to fund, you can invest in a 506b or a 506c, because a 506b is capped only to the extent that there's non-accredited investors. Well, if you're doing a fund to fund, well, you're only raising capital from other accredited investors. You're not going to run into any issues. But if you're doing a 506b fund to fund, then and you're capital raising with that sponsor, y'all need to be in constant communication as to how many non-accredited individuals have come into play. I recommend the sponsor share a editable Google Sheets where the capital raiser can say, sign this person, sign this person, sign this person, so you can keep tabs of how many 35 non-accredited investors that you have, because if they're accredited, you wouldn't even list them because you're not concerned with that. So I hope that I kind of covered a little bit about what that fund to fund looks like, how its function comes in a syndication. Basically, a fund to fund is simply a large swath of the Class A units that might be available, but for some reason that sponsor is keeping some anonymity between the investors and the underlying syndication. Having said that, I'd kind of like to open up the last 20 minutes for any questions, expand upon anything. I can go into detail about another matter, but I find that a lot of people like to ask a little more targeted questions, maybe about what they're going through or about what they're seeing. And I can certainly advise on stuff that I'm seeing in the market with the different clients that we have. But I'd like to open up this time now for any questions that someone might have.
Thanks, Kyle. Yes, please, team on the phone, please ask your questions if you have them to get things kicked off, Kyle. Actually, I think one great slide that you have in this deck is around sort of the anatomy of a PPM. And we have a lot of investors here that may be, this is a daunting document, right? And so getting people acclimated with what the PPM is about, how it works, how does it protect their interest and the interest of the syndication group. Maybe you can go into some of those things and as people formulate their questions.
Sure. Yeah, so whenever you're syndicating as the sponsor, you're preparing 3 documents. You're preparing a PPM, a private placement memorandum. You're preparing an OA, an operating agreement, and a subscription agreement. The subscription agreement is where the investor is subscribing to the company. I'm saying that here's $100,000. I'm getting X amount of Class A units, and I agree to this subscription. I'm filling out a questionnaire that explains that its role and what I'm signing up for. The operating agreement is the investor agreeing as to how the company will be run and operated, right? That's going to be where the preferred returns are mentioned, the cash flow is mentioned, other distributions are going to be mentioned, and the management rights. Like the manager can do A, B, C, D, E, F, G, all the way to Z. The Class A investors don't have any voting rights. They're strictly passive, right? The PPM is kind of a one-stop shop. The PPM is going to say that, certain risk disclosures are there, federal tax consequences are there, parts of the operating agreement there, the business plan is there. The PPM is going to be where you're saying the property that we're acquiring is Apple Creek Apartments in Houston, Texas. The reason we're really excited about this is the employment hubs and the renovation plan that we're going to do, repay, put in LPV flooring, stainless steel appliances, raise rents to markets. So the PPM has a little bit of everything. It's not necessarily a binding document, but it's something that is required in a 506B and heavily recommended in a 506C because it lists out all of the risks and debt financing and real estate in general. Other matters like, due to supply chain issues, there may be a halt in the renovation plan, things along those lines. So the PPM is going to mention the property information. It's going to cover the sources and uses of the funds that are being raised. It's going to mention any conflicts of interest. For example, the sponsor may have a construction company, and that construction company is going to be the one doing the renovation. It's going to say, hey, we have a financial interest not only in this property as the sponsor, but also as the person that's going to do the contracting, things along those lines. I hope that answers kind of your question in terms of what's the role of the PPM and how does it intertwine between the Class A and the Class B. Richard said, let's see, I don't think that answers right. Since the LLC itself should be an accredited entity, if it has combined 5 million or greater, though it allows non-accredited members. Yeah, so if you're doing a 506C fund to fund, then you can invest in either a 506B or a 506C. If you have a 506B fund to fund, then you're only going to be limited in investing in 506B syndications. Again, the fund is created to invest in a direct syndication, and that's kind of the role of that. Richard, feel free to unmute yourself and maybe kind of ask a more targeted question to the extent that I'm not adequately answering it right now.
Or if anyone has a question,
or anyone really,
while Richard's figuring that out on mute, please. No, he said that answer. Thank you, Richard. Anyone else have any questions or comments that they have?
Or if anybody wants to share kind of something that they're doing now, maybe they've got they're looking at an offering now and they're looking to do this or that, or maybe they have any questions about kind of what I'm seeing other syndicators do. I'm, certainly happy to answer in any way.
Kyle, this is Zach. Could you talk a little bit about the differences between when you're bringing a deal to maybe friends and family versus bringing a deal to other syndicators or to accredited investors? How do you kind of approach just sharing the deal and getting people interested in it?
Yeah, that's a great question. So a lot of times this is going to be driven by you knowing the network that you have initially. So if you've already wanted to take the plunge into being a sponsor, one of the first things you've probably done already or should do is make a list of 20 people. Like I have an uncle that, likes investing in real estate. I have college buddies that I know are doing well right now. I have a colleague that is looking to invest passively, or I've heard friends of mine complain about the stock market volatility, whatever that may be. Write out 20 people, then write out another 15. And what you're going to realize is you probably know a lot more people than you think that you realize, right? One of the things that kind of drives this as well is what's the raise that I'm looking for? If you need to raise $1 million, while that might sound daunting, that's a pretty easy number to get to, particularly if it's your first deal and you lower the initial investment to $10,000 or $25,000 as opposed to 50 or 100,000, right? That's actually pretty easy to get to pretty quickly. If you are needing to raise 5 million, maybe you're thinking, okay, maybe I need to make this a 506C. Maybe I need to advertise this more. Maybe I need to put this out there more in order to raise this. Another thing to think about is how much of this raise can I, like if I need to raise 5 million, I know I'm good for $1 million. I need to find someone else that can raise 2 and another person that can raise 2. And there I go. So one of the things that you want to be thinking of, who are other people that I've met at conferences or presentations like this that are wanting to get in this space? And if you have a deal, you can say, hey, if you can raise 2 million, I'll give you 20% of the GP. And then they'll say, great, that's awesome. I get 20% of the cash flow and the profits when it sells, and they'll go raise that capital, and then you as a group kind of learn and do it together. If it's your first deal, I highly recommend kind of sourcing that as well. And if you have a good attorney, like someone at Robinson Fransman, with a shameless plug, they're probably gonna know a lot of clients that raise capital. Like, for example, I have right now 3 clients that don't do any underwriting, that don't do any due diligence. The only thing that they do is raise capital. So if you came to me and said, hey, I have this deal, I'm kind of worried about the cash flow, I would be able to say, well, or I'm worried about the capital raise. I would be able to say, well, look, I have a client that raises capital. I'll put you two in touch, and then y'all can try to work something out, and they can probably bring the entire 5 million. And then that's something you don't even have to worry about anymore. You can be focusing on getting good loan terms, getting good insurance quotes and whatever. So the thought about this is all about partnering both with passive investors and other sponsors themselves, right? Like I always would like scream at the TV when I was watching Shark Tank back in the day, because I would see these people come to the sharks and they'd be like, oh man, I don't know if I can give 10% of my company. 10% of your company? I'd give 30% of my company if I had, Kevin O'Leary or Mark Cuban helping me run the show. Are you kidding me? I would much rather have 5% of a watermelon than 100% of a grape. And it's not particularly close. So feel free to share that wealth, because the sooner that you close, you can go to the next one and the next one and the next one. And that's kind of the beauty of partnering in this space when you kind of get to that point. So Zach, I guess to answer your question is, you kind of need to know, to start with, who are people that I can rely on in my own network, and then who are people that I've networked with that might also could capital raise. And look, if you've got a good attorney that's been in this space before, he's going to know a lot of people, preferred equity groups, or other clients that are looking for deals to get a part of too. So while you should be concerned about raising the capital in terms of, not aiming too high, your attorney hopefully will be able to steer you in the direction of someone that can help. You don't want to go to an attorney that can only do real estate and doesn't really know any other people in this space. You don't go to a foot doctor to ask them questions about their heart. Like, go to an attorney that is sophisticated in multifamily or self-storage or syndication or capital raising, because they're going to have other clients that can help source that if you kind of find yourself in a bind. I hope that answered your question, Zach.
That's perfect. Yeah, thanks.
Richard asked, can you share the types of PPM language or offering wording that might alert a passive investor that distributions might be a return of capital versus a return on investment? Yeah, so that's kind of, I don't know, Richard, if really what you're getting at is this sort of American model versus European model, but that's going to be clearly outlined. So basically the way that I work is, if you come to me to do a syndication, I send you a questionnaire, and then you fill out that questionnaire, and then I kind of fill in the documents as to kind of what you're offering. So you can do a situation where the 7% preferred return is a return of capital, or it's a return on capital. That's going to be something that the attorney is going to adequately draft in the PPM and the operating agreement. That way they can't come back and say they didn't know that that was going to be one or the other. Typically, you see a return of capital, or sorry, you get a return, a return of capital, where the preferred return is based off the initial investment, and that preferred return doesn't decrease unless their initial capital is returned. But you can also structure it to where it's a return on investment. Part of of you figuring out which model is going to work best for you is kind of knowing the investors that you're going to. Hopefully you have kind of ask some of these investors, like, hey, I'm looking to get into multifamily. I'm going to offer about a 7% preferred return on capital. What do you think about? And that'll be a return on your capital or return of your capital. Does that sound good to you? And, maybe you've spoken with 30 people and 20 of them said, no, I want a return, on my capital, not of my capital initially. And then that's kind of where you start to structure your syndication itself. But a lot of these questions are kind of going to come, or these answers are going to come from you, where you're going to say, you know, all of my investors are going to want 6% or 8%, and that's what I'm offering, or they want to see 80-20, not 70-30. And there's kind of ways you can get around that. It's called IRR hurdles. Like if you return so much of their money to them so quickly that they've made 15% on their investment, then the shift comes from 70-30 to 60-40, and that gets more money in your pocket. While it's less in theirs, it's a win-win for both, and investors are certainly can appreciate that it gives you an incentive to fulfill the business plan as quickly as possible and as efficiently as possible. So Teddy asked, Kyle, are you licensed to draft contracts and PPM? Any referrals that you can share in Denver, Colorado? Great question. So we can actually do deals in any state. We don't have to be licensed in the state that it's in, largely because what's driving this is federal security regulations, not necessarily the contract itself. While I'm barred in Georgia and Mississippi, as you can probably tell from my accent, I have either been the lead attorney on or co-attorney on deals in Arizona, Texas, Florida, Tennessee, North and South Carolina, Virginia, Pennsylvania, Illinois, Indiana, Arkansas, just off the top of my head. So if you have a deal and you're wanting to find an attorney in that space, I can certainly help you out there. The only time that we might ever feel that we need local counsel might be if the property's in like Washington, D.C., because there's a lot of Congress federal oversight, that there might be some local federal rules that apply to DC that wouldn't in another area. And that might be where we get local counsel, but we're still going to drive the PSA negotiations, the syndication and everything. They just might help us with any sort of local ordinances that we need to be aware of. But that's not come up in my practice or with any of the partners that I work with. So that's a good question, Teddy.
Great. So thank you, Teddy. And then I'll throw another one out there, Kyle. What do you say to both passive and active investors, or GPs and LPs, about those who want to invest in these type of deals using their retirement, self-directed retirement accounts? Are there any special considerations that need to be taken there?
No, there's typically not. And while I understand how the self-directed IRA comes into play, a lot of times that is driven by the custodian of the account in some way. Like if you have an IRA with Vanguard or anyone else, doesn't matter, Wells Fargo, whomever, a lot of times all they need is the subscription agreement and the operating agreement so that they can okay the funds being deployed in a certain way, right? So a lot of times that's going to be driven by the specific custodian of the account, less to do with us. But I've never come across one of my clients having an issue getting Vanguard or someone along those lines to distribute the funds. Typically, if anything, they ask me for a letter, perhaps like the syndication, something on firm letterhead. A lot of times we'll give our wiring instructions. So that you usually see that from the custodial side, not so much as an implementation on your part or our part. One of the things that, the benefit that you get with Robinson Franzman is, we can do title, survey, escrow, PSA, purchase and sale agreement negotiations. We represent you with the lender. We represent you with any private equity groups. We perform the syndication documents for you. We file them with the SEC, which is the federal oversight group. And then we file the necessary state-specific filings that might. So we handle everything from start to finish. The only thing that we don't do would be some sort of like eviction proceeding, because that's active litigation and that's something that you have to do to be barred in that state. So even if the property were in Georgia or somewhere where we're barred, we just don't hold ourselves out to be eviction experts. So that's the only thing that we wouldn't do. And obviously we could represent you back on the sale side. and anything like that. I've got sample LOIs that I've submitted on deals myself that have gotten me to best and final several times, but no shame in the game. I've lost out to someone that's been in the space a little more sophisticated and the seller went with them. It is what it is, but I'm happy to send, LOI templates. I've done that in the past. And typically the way that our firm works is if you wanted to use our services, we usually start with an initial retainer of $5,000, for example. That gets you through the purchase and sale agreement negotiations and all of that. If you end up terminating the deal, then we can just refund you the difference. We'd obviously like to collect for the hours that we spend negotiating the PSA. I think that's fair. Or we can keep it and roll it into your next deal. But when it comes along, that decision's yours. The syndication documents, we flat fee, and we're fine with taking that at closing. So you don't have to bear that upfront cost as well. Typically, I tell potential clients or sponsors when you're trying to budget what all this means and whatnot, usually it's going to be in total 20 to 25,000 in legal fees to acquire the property. Again, we can get a lot of that at closing. So the investors that you're bringing into the deal are kind of paying that on the back end. And really all you've done is front the initial retainer and you can be reimbursed for that. Another thing, so I hope that kind of answers that question. And another benefit of the firm in general is that, like I said earlier, we have a lot of clients that raise specifically for other people's syndications, and we can kind of help point you in the direction if you're kind of worried about being able to raise equity. Now, I'm not suggesting that you need to put out offers on $100 million properties, thinking that your attorney will be able to point you in the direction of someone that can bring $20 million to the table. I'm not suggesting that we can do that. We're not miracle workers, but we can certainly point you in the direction of people that specialize in capital raising that, y'all can kind of have that discussion. We're not a part of it. We don't sit there and handhold the negotiations. Our philosophy is if y'all can't get along in negotiating kind of your GP splits, then you just don't need to work together, because if we have to get involved, then it's already probably not going to work out. But that's kind of what we provide. And we've got a very good client base. We can certainly set you up with people that have done deals in virtually any state. If you're kind of looking for guidance along the way, all we can do is reach out to our client and say, hey, would you be interested in talking to this person? If they don't, they don't. We can't make them do it, but we can certainly point you in the direction along the way. And because we've been a part of so many large, sophisticated deals and smaller deals, we can kind of coach you up to a level that you might not have gotten from another attorney, because we could say, hey, typically syndicators do this, not what you're doing, or this or that, and their presentation looks a little bit like this, and we can kind of make you look like this is your second or third deal as opposed to your first deal.
Great stuff, man. Great stuff. Well, look, I know we're getting close on time, and I just want to just thank you so greatly for taking the time to educate all of us today. We have some passive investors on, we have some active investors on. And I love the analogy of the airplane that you used when it comes to taking down these deals, right? When you think about it, it really is a team effort, and everything does need to work in concert, where the GPs who are really hustling and finding the deal, analyzing the deal, doing all the due diligence, all that work that goes into it, raising the capital. And then you have the limited partners who want a great real estate deal, and they just want to find a place to place their money in a nice, safe real estate asset. After they do their due diligence and then put those things together, and magic happens. And I really appreciate you taking the time to educate everyone on this. Before we let you go, how can those on the call here tonight, and those who may watch the recording on YouTube once it's posted afterward, get in contact with you?
Yeah, happy to share that. But one thing I kind of want to touch on, Chris, is, one of the things that I think sponsors probably could do more is kind of telling these passive investors how this can create generational wealth over time. Like, for example, if someone gave $50,000, obviously they're going to get the little preferred returns per quarter and whatnot along the way. But by the time it sells, they'll get their $50,000 back, and then they'll probably get whatever their pro rata ownership interest is in the deal. So let's say that $50,000 is returned, and then they get an additional $35,000. So now they have $85,000, right? They can 1031 that into another syndication tax free. So then that 85,000 becomes 125,000, and then that gets 1031, and then that gets 1031. So somebody now at 40 years old that has $50,000 to invest could 1031 that for the next 20 years tax free, and that 50,000 could have become, God, who knows? It just depends on the deal and whatnot, but that could have easily gotten into $400,000 or more over 20 years. And then that's kind of like their hedge against the 401k volatility when they go to retire at 60, right? So they can just keep 1031ing the money over and over and over, never pay tax. And then bam, there you go. They're able to retire more comfortably. So it's a really good investment vehicle. I think it's better than 401ks personally. And I'm not just shamelessly saying that because it benefits my clients or anything like that. It's just appreciation is always going to be there. The value add strategies are always going to be there. And at the end of the day, you're investing in something that people need. People need shelter, apartments. People need a place to store their stuff, self-storage. Companies need a place to house their inventory, warehousing, right? So you're kind of doing all of these things that are never going to go away. And it just creates this generational wealth opportunity for your investors and for the sponsor. So it's really a win-win. For those looking to get in contact with me, I'll just go ahead and comment my email right there. But it's gonna be in this presentation, but you can reach me on LinkedIn. Assuming I haven't hoarded myself out to most of you already on that platform. My email is Kyle, K-Y-L-E, at rfllplaw.com. And our office phone number is 404-255-2503. And if you don't mind, if you happen to reach out to me because of this presentation, please kind of mention that in the subject heading, that you attended the Chris Price meetup, and that gives me some context to where you came from. This is probably my 4th presentation, and I've done 4 podcasts already. So it kind of helps give me a frame of reference to where you might have come from so that I can kind of remember what I discussed at that time. But, I'm happy to answer, any questions for you. And if anybody has any now, I'm certainly happy to stay on. There's no shame in that. But, if anyone has any questions, I'm here. You can reach me on LinkedIn or anything like that. I rarely get on Facebook. It's mostly just grandmothers arguing at this point about Joe Biden or Donald Trump. So I'm not really there anymore. Instagram, whatever. So just find me on LinkedIn or reach me out on email. I'm happy to help any way I can.
Kyle, great stuff. And one last thing for the folks who may not be aware, give them the tip on the 1031 tax deferred exchange. Tell them a little bit about that just before we close out so people know what to look for when they go Googling later.
Yeah, so a 1031 is basically a like-kind exchange, and I won't get too granular with kind of like how you do that because like we'll take care of that on behalf of our client that'll ultimately do that for you. But basically what it is if you have an initial money that you invest in a syndication, okay, when that goes to sell, if you want to 1031 that, we do what's called this is okay. I'll try to scroll up here. So this property here has a deed, and it would be deeded to Investment LLC. If you wanted to 1031 your money out of that, it would be deeded from Investment LLC to Investment LLC and John Smith. And then John Smith will take his proceeds, send it to a qualified intermediary. That's the group that handles 1031s. Attorneys can't do it. The GP sponsor can't do it. It's got to be a specific qualified intermediary. And then he holds the funds. And then if you invest that in another commercial real estate property within, I believe, 180 days, then you can roll that money into there tax-free. All of those proceeds will be tax-free. And then you kind of deploy that into that deal. Then when that balloons, you take it into the next one, into the next one, into the next one. And that's kind of the way that you go about that. The real implications of that are seen best with, a good tax attorney, or your own CPA, mind you. But if you're looking in a position to where you kind of want to create generational wealth and you don't really need the proceeds from that, I would suggest 1031ing it, possibly even into the sponsor's next deal. And then you'll just be able to continue to grow that wealth in the same way that you could have a 401k, but faster, because it's a 5-year hold. You get your money back quicker. You're not going to really get returns like that. Your return on investment is probably 20% in a typical syndication, somewhere along those lines. And I just don't think you're going to get 20% in the stock market in a 5-year period. Even if you do, it tends to kind of level back down anyway. So I think that 1031ing money from a syndication is a really good way to create generational wealth for yourself and your family.
Perfect stuff, and a great way to wrap it up. So I'll hang back for any questions or comments from anyone. In the meantime, Kyle, again, thank you so much. Went out this presentation along with the recording, and your contact information will be sent to everyone that attended the meeting, and all those that who were not able to attend will be able to receive the all of this information, including the recording, which will be posted on our YouTube channel. So thank you guys for your time this evening. I hope you have a great rest of your evening and a great weekend. Take care and have a good night.
Absolutely. Thanks for having me again, Chris.
Thank you.
Thank you.
Thank you, Al. Thank you, Richard. And thank you, Laurelyn.
Thank you. It's very interesting.
Great. I'm glad that you enjoyed. I'll stop recording now.
Okay.